good morning or good afternoon all, and welcome to the Tele AG Q1 2025 results. My name is Adam, and I'll be your operator today. If you'd like to ask a question during the Q&A portion of today's call, please dial in and press star followed by 1 on your telephone keypad to enter the queue. Now hand the floor to Carmen Becker to begin. So Carmen, please go ahead when you're ready.
Thank you, Adam, for the introduction. Good morning, ladies and gentlemen. This is Carmen Becker speaking, and it's my pleasure to welcome you on the name of Tele management team to today's conference call following the release of our first quarter results for fiscal year 2025, which ended on the 31st of March. This call is limited to 120 minutes. In case of any follow-up questions, please let me know. I'm here today with Markus Oswald, Chief Executive Officer, and Nikolay Ostwald, Chief Financial Officer. Now, I would like to remind you that if any lenders or rating agencies are on the call right now, that this is a public conference call in which only publicly available information will be discussed. I would therefore ask you to refrain from questions containing information not belonging to the public domain. This conference call is intended for capital markets participants only and not for press representatives. If any journalists are on the line right now, we would highly appreciate if you were leaving the conference call now. Press representatives are welcome to call my colleague Sebastian Artymiak to discuss any outstanding questions. Having said that, it's my pleasure to hand over to you, Markus. The floor is yours.
Thanks, Carmen, and good morning into the round to our Q1 25 result presentation. Let's dive in directly into page 7, I would say, because the tableau is the same like always. Sorry, 5. Yeah. To the key remarks. Yeah, sorry, I just messed up my paper here. So on the operational side, it is a pleasure to see how our internet sales continue to grow despite we performed a price increase in Feb 25. So again, the TC remains the fastest growing internet operator in Germany. Increase of 10.6% year on year and quarter on quarter 18.5% revenue growth, despite a really overheated competition in the market. I will comment on that later on. When we are looking or deep dive in deep a little bit nearer to our IP performance, it is again that we performed on 50% gross adds, which opt for 500 megabit and more. It is near to 80%, with now going for 250 and more. Our 3P share slightly declined a little bit, but this is complete in the range of what we expected. 47% retained TV customer after migration. Coming to the financial comparisons, revenues Q1 25, 104.9 million. One-off regulatory TV losses due to bulk migrations are not yet fully offset by our internet growth, but back to growing revenues on a quarter-on-quarter comparison. Reported EBITDA slightly increased 1% to 32.5 million, based on operational performance and significantly decreasing non-recurring expenses. Normalized EBITDA 18% down, 39.1 million. This is reflected by the TV bulk migration or impacted, of course, by the TV bulk migration losses. CapEx, excluding leasing, decreased by 13%, 35.9 million, mainly driven by lower investments in network infrastructure and CPEs. Coming to liquidity, cash position of 88.5 million as of March 31st, 25, and with the information that the shareholder loan was fully drawn by end of March 25. Compared also to our CapEx, what I mentioned before, selective capital allocation, focus on operational excellence and net working capital to manage our liquidity. And now coming to the comparison again, you know that chart of our internet performance. What we see here is strongest performance compared to our competitors. The gap to our competitors is again really significant. And I would say if you normalize our growth rate by one-off impacts like the price increase, you will be back again near to 12% growth on a year-on-year comparison. But let's stick a little bit to that slide or give me some comments on that. What we see in Q1 25 in the market, and I will later show you also, or I will comment our gross ad performance because this is what we are also forecasting. Compared Q1 with Q1 the year before, our gross ad performance is nearly the same. And we also conduct some decisions during Q1 because what we see in the market was really a tremendous overheating of the market. There are commissions paid by competitors in the market, which, sorry to comment on that, in some cases really went crazy. And we decided not to put in money in non-profitable growth here in that case. And this also impacts these slides and also conclude our analysis or analysis are going on what will happen in the market. Because when you see then competitors' performances compared to what they invest in that first quarter, we would expect that this not first analysis, our expression was, okay, these are one-offs, or it will happen now and then they ended. What we are expecting during the course of the year, that this will continue and that this will continue, and we have to see how we can compare to that growth. Right now, really, really good. And coming to the next page, this is what I meant. When we distract the one-off effect, because actually we had a growth of net adds by 6.1 thousand, but when you normalize it without the one-off, the gross adds are nearly the same, so we only have a decrease of minus 7.3% normalized by these one-offs. And the one-offs you also can see on the right side, the positive side of the one-offs, because we see that 57.5 million on service revenue on internet and telephony revenues, which is really an increase here and compare it to quarter 1, 24, 9 million is really a gap which we want to outperform now in the same direction. And a good sign that also with our price increases, we can really manage our base where possible. That's on that slide. Here you see that 6,000 growth on our internet base on quarter 1, 25. Looking also what we performed on the FTTH side, and this is a mixture out of that, more than 700,000 RGUs, which we are now having. We are now with nearly 200,000 FTTH customers and a penetration of 44%. So completely in line with our strategy, upgrade to FTTH where necessary, where the demand is. We see a good growth pattern and also in our DOCSIS 3.1 footprint. So this double strategy on DOCSIS combined with FTTH where necessary and asked by housing association is exactly the path we want to follow. And the penetration and also service revenue growth, like the slide before, says that this strategy is exactly the right one. When we are looking, I referred in my first page onto that. This is a mixture of our gross adds here. So below 250,000 something around 20% like the quarter before, with some promo actions. We also worked on the middle one, but this is exactly 250 and higher. It's 80% right now, 50% still strong, and this is now continuous over the last complete year. The demand for 500 megabits, or so you can choose between 500 and 1 gig. So 45% is the graph below is the 3-play share, which also is completely in line with our expectation here, due to the fact that in 24, of course, it was the TV bulk migration which influenced the high share rates during the course of the year. Coming to that point, so we are now on 47% retained customer rate in Q1. Still work to do, slight decline in penetration, which is also linked to our price increase here in case of the 3P share, like I mentioned before. So still targeting the corridor of 50 to 55%. Additional direct sales actions together, hand in hand with housing associations, are in the pipe, performed in the past, are in the pipe again, and also the disconnect topics are raised and continued to board it into the market and to our households. This leads, so we lost something around 6,000 customers on the TV side, here, especially on the TV individual access. Again, like I mentioned before, also an impact out of the price increase we performed on the IP side. So hand in hand, it goes also with the premium TV, that performance on TV. That's for now from my side, and now I hand over to our CFO, Nikolay Ostwald.
Thank you, Markus. Looking at page 14, if we talk about the performance on revenue side, I would like to point out that first, we are back to growing revenues quarter on quarter. I think this is a strong message that after the downturn on the bulk TV migration, that we finally see that the bulk revenues are stabilizing at around 3 million, which is some good news. And then we can now finally see the underlying IP, internet and phone growth that is coming back and going through. And as Markus mentioned, the quarter was influenced by the customer-based price increase that we've seen. So this is a strong message that hopefully from now on, if we continue to keep bulk stable, we're approaching closely the 200K subscriber base that we've always said that this might be the long-term range of those 200,000 that remain. This can be stabilized, and then we'll see the impact on the individual measures to uplift still the TV revenues, and then basically, but having the strong impact from the internet and phone growth. In terms of revenue composition, below, nothing has changed. Very stable numbers. We're well above the 50% and closely 55% now, but that is the constant picture, so no news on that line. Go on page 15 towards the reported EBITDA bridge. Obviously, still impacted by the bulk migration. We've mentioned it. We've seen that the revenues are down roughly 7 million, of which a downturn of 15 million in the bulk. But the 9 million growth from internet and phone, and then the other related stuff is, as we've mentioned a couple of times, the Marienfeld churn that we've seen in the past, which still had an impact in Q1 last year, which obviously now was felt. On the other operating income, we had one-offs that helped to be better than the last year. On the direct costs, also slightly better in terms of the signal fees, also driven by the Marienfeld impact, similar offsetting the revenue downturn. On the personnel side, still increased costs due to FTEs on payroll and salary increases, and that is something that we are going to tackle with our operational excellence focus. We've mentioned it in the last call, and this is now a priority to us. Also, to look at the cost situation that we have and improve further going forward. On the marketing side, we did have higher costs. There's two things. Also, as we last year saw the possibility of showing some marketing spending in the non-regs because it was related to the TV bulk migration, and some measures also have impact on all the product lines, even though if it's related to the bulk migration. We have seen that one, and also we had a push in the marketing in Q4, in Q1 compared to Q4 last quarter and last year, where we were a bit more cautious in terms of spending because the Q4 seasonality obviously helps to make more gross adds at lower costs. We know Q1 was a bit of a heated market. Markus mentioned it, and we had to carefully allocate costs, but still were forced to compensate churn on the price increase side. So we wanted to perform on the gross add side, which we've done on a similar level compared to last year, but that required a bit more marketing power to reach that performance. On the EBITDA side, down the 18% on normalized, and then again reported EBITDA at 32 million. As we've seen non-regs coming down significantly. That was mentioned throughout the last calls, that 23 and 24 were substantially higher and on very high levels, close to the 50 million. And we do see significant improvements on that for the current fiscal year. In terms of CapEx on page 16, we've seen a strong decrease, 13% year on year, coming from 41 million down to 36 million. The pattern in comparison to a strong Q4 is the normal pattern that usually Q1 is much lower, and then during the summertime you build up, and Q4 should be stronger in terms of finalization of projects and interim cutoff of projects that will be finalized. So that's the normal pattern. So Q1 is expected to be lower, but also it's slightly lower compared to the last year Q1. We've seen slightly lower numbers on the infrastructure and customer related CapEx, which on the network side is mainly related to backbone, DOCSIS 3.1 and maintenance CapEx, while we still maintain a high fiber rollout. On customer CapEx, we spoke about it. It's mainly related to the CPE spend, and the commissions are in line with gross adds, so that is mainly related to the CPEs. And then finally, on IT and operations, we basically maintain a high capitalization ratio with the project, so therefore not too many changes here, but pretty much in line with what we expected. Summarizing the financial performance, the decline in revenues still to the loss of the bulk migration TV side, and yet not yet fully offset with the individual growth. But as I mentioned, growing quarter on quarter now, finally, hopefully coming back into the growth mode and then compensating as of Q3 once it's fully washed out the impact from last year. Hopefully we see the underlying internet and phone growth that will then eventually show and help to improve the numbers. On the reported EBITDA, we mentioned a slight growth, basically driven by the significant decrease in the non-recurrings. We will have to look closely as we are further pushing operational excellence programs. We look into additional FTE programs, so there might be some more severance payments needed throughout the year because we want to accelerate what we've started in December. The first phase has been agreed with the Works Council. We've announced that, and now we are even pushing harder, so there might be some additional one-offs coming up, but this would definitely then improve long-term performance in terms of cost ratios and margins going forward. On the investment side, excluding leasing, we mentioned significantly lower. We also decided to take some capital allocation measures as we've done in the past. And then we have the seasonality of Q1, but still lower than last year. On the operating cash flow, there is a significant decrease, and I think it's quite important to mention that this is basically related to a one-off impact prior year. So what we've seen is that the usual direct debits that are pulled were last year, no, in 23 December shifted to January 24 due to processing issues from the banks. So we had a significant one-off impact in January simply because the processing of the bank did something 2 days later instead of what it normally should have been. So that is a direct debit run. 27 to 30 million is normally the direct debit run that we see, and that is basically the big deviation to the numbers that we see here. So it's not really operationally from our side or any net working capital impacts. This is simply driven by a bank issue that happened in Q1 2024. So that is basically the explanation for this big deviation. So this basically concludes our short presentation today. In the annex, you will find some further information on net debt. I'm not going into details, but I have received many questions from the market with regards to what is net debt, what's the debt situation, how does this work with the PIK interest, with the derivatives underlying. So hopefully this will shed some light to you and bring you some more information. If there are still questions, please reach out. But I think this is just helpful for documentation and maybe analysis for you. And that basically we can come to the Q&A session. And maybe before we start the Q&A, just one final information, because again, I've been addressed by quite a few people that they are never invited to these calls and are not informed when these calls take place. Please do register, and please add. Once you register for the Investor Relations portal, you have to sign up for the newsletter and the information request. Otherwise, you will not be informed about the dates and the registration link. If you are registered, please check that you are on the list. If not, please contact Investor Relations. Unfortunately, I cannot invite you individually. That doesn't work. So please sign up, and then you will be informed. So now I'm handing over to Adam to basically lead through the Q&A session. Thank you.
Thank you. As a reminder, if you'd like to ask a question on today's call, please dial in and press star followed by 1 on your telephone keypad to enter the queue. When preparing to ask your question, please ensure you are unmuted locally. If you've joined us online, your dial-in details can be found to the left of the slides. And our first question today comes from James Ratzer at New Street Research. James, your line is open. Please go ahead.
Yes, good morning, Markus and Nikolay. Thank you for taking the questions. I could ask lots, but I will keep it to 2, please. So the first question I had was I was wondering if you could give us some outlook or thoughts around EBITDA for the full year. I notice in the report you seem to be saying you've pulled formal EBITDA guidance at this stage, but a month ago at the Q4 call, I think you'd led us to believe that at this stage you might have been in a position to give guidance on normalized EBITDA. So any comments on the kind of change you've seen over the past month would be helpful. And if you can give us any comments around normalized EBITDA outlook for this year, that would be very helpful. The second question, kind of bigger picture, is just around the pricing strategy on internet. Because if I take your comments from the last earnings call, I think you said you were putting through a kind of €2 increase on around 150,000 customers. So that's about a 7% price increase for them. But it looks like you've lost about 8,000 customers on price-related churn, which is about 5% of that 150,000 base that were affected. So the question I'm really kind of angling at here is therefore it really worth it if it's led to you then having to spend more on retention? Is a price up strategy something that is NPV positive for you at this stage? And how are you thinking then about future pricing moves for the rest of this year, given what you've just seen happen in Q1? Thank you.
Yeah, James, happy to and Nico, please add to take your questions. first of all, what we also said to our guidance is that we are now analyzing again what we saw in quarter one and do our assumptions on the following quarters. So the pressure in the market is right now really heating up, so we have really now do it on a not weekly basis, but at least when we are looking at our promo actions and so on, what is done by the competitors. And we really had just 1 week ago a decision taken. Okay, we saw promos in the market which we don't want to go, because they are definitely coming now to your action also on the price increase. They are really cash negative on a single gross add. So, and that led us to our decision to say, okay, let's wait and see what happens in the market for the next quarters, because it continued in more than we expected to have that commissions promos from competitors in the market, what we also saw in April, for example, or also now beginning again. So this is the first point on what is our growth pattern on service revenue growth on the IP side. So point number one. So there is what will happen in the market. For us, also astonishing after our call, seeing some quarterly results on our competitors, compare these pressure in the market with what they reached on growth. To be said honest, we would expect it more, and see now in our comparison sheet here on page 7 what was the result. So out of that, we lead into the expectation that they will continue to improve also their business, and they have different pockets like Tele Columbus, to say that, compared on their marketing spending. When we look at our price increase, I would definitely say it is worth doing it, because what we actually do, it is not just putting here in euro and here in euro on, because we bring cost rises in our structure to our customer where it's possible by law, and this is what we need to do, and we will continue doing that over the. I think I explained it here in that as well. When we speak about price increases and a column of 150,000 or a pocket or a package of 100,000, 150,000, this is what we mention. It is happening during the year as well, but then in smaller slices of our customer base. So price increase, I would say every competitor is doing it. Compared to our churn, we still are really confident to continue on that, and will do that.
That's great. Thank you. So can I just one follow-up just from that? Does that mean based on what you're seeing from these promos in the market, you've seen a kind of weaker level of internet net adds continue into April and May as well?
A little bit, yes, and this is because we are now taking actions on both sides. We look at our product portfolio as well, so we also have ideas of answering that, and we will add to that just as a caution measure, or more than a caution measure, on our operational excellence program in the company to be prepared for the future, a stricter and a more razor sharp measures here in that state. So we have to look at our costs. Every euro who's going out of the company is now looked again. And we also, on the operational excellence side, like I mentioned before, last year we agreed with our Workers' Council on a social plan of doing that, and we will take additional FTE measures to, in that case of operational excellence, to from now on, And this, which Nico just quoted on, will also lead to a better cost performance in the future.
Got it. Okay. Thank you very much.
A pleasure, James.
The next question comes from Sam Morton from Invesco. Sam, your line is open. Please go ahead.
Hi. It's just a couple of questions really related to the balance sheet. So I guess we can see a liquidity of 88 million at the end of the quarter. I'm just interested to hear how you think that will evolve over the coming quarters. And I guess the big change on the balance sheet in Q1 was the increase in shareholder loans, which are now up to 363 million. I think it's in the release that they have a 17% coupon. So I was just hoping you could tell us the timings of the cash outflows related to those. Are they quarterly, semi-annual, or annual? Thank you.
Sam, let me take that question. First, on the liquidity position, it is what you said. Yes, the shareholder loan was fully drawn. Very important to know, this is fully PIK interest, so none of the 17% is being paid out over the time. The target, as it was always mentioned, is still to swap the loan into equity. And this is in the making, basically. So we're preparing everything that we need, as it was previously agreed last year in the A&E transaction, that the shareholder loan eventually would be swapped into equity. So no cash out interest in terms of the loan. The loan itself is 300 million, and the 60-something is now the accrued PIK interest that sits on the balance sheet, including also some derivatives and other stuff.
Okay, and then just the liquidity in general, can we just talk about that?
Yeah, liquidity in general is, based on net working capital impacts in Q1, that is the normal pattern for this type of business, that we always see higher payouts in Q1 after the stronger Q4, especially on investments. We do not expect a lot of impact in terms of net working capital with regards to inventories or receivables, but the payouts that we've seen in Q1 basically also has a lot on payments with regards to deferred expenses. That's what you see that has increased. And we also have usually much higher lease payments in the first 3-4 months compared to the normal average over the year. So the current expectation on liquidity is to basically stabilize throughout the summer, and then in Q4 work up some of the net working capital impacts to bring back the levels in order to basically fill up payables that then will be paid off again in Q1 2026. So we have the seasonal pattern of losing or having cash out, leaving the company stronger in the first couple of months, then over the summer basically flattening out, and then towards Q4 having positive impact from net working capital. That's the current assumption.
Great, thank you.
As a reminder, if you would like to ask a question on today's call, please dial in and press star followed by 1 on your telephone keypad to enter the queue. The next question comes from Martino Santicoli from Tiki Capital. Martino, your line is open. Please go ahead.
Yes, morning. Thank you for taking my question. I just had a quick one in relation to the price increase. I was wondering whether you are expecting additional churn in Q2, or whether the peak churn is already behind us. And then a follow-up from this one is, where do the customers that churn actually migrate to? Do they go back to DT's copper or anywhere else?
I can take that question, Markus here, Martino. So no, we didn't expect additional churn out of the price increase. So this is washed out now, because letters are also sent out last year. So the impact is really in the Q1. And when you look in our building structure, so the customers are moving, in that case, then back to DSL or other possibilities. Mobile may be as well, also a little bit, but this is really in our comparison to competitors, minor. So so DSL or wholesale partners of Deutsche Telekom who are on the network of DSL, because the lines in the building are either Tele Columbus, DOCSIS 3.1 or FTTH, or a DSL copper line, which is run by DT or Vodafone 1&1 or who else is on the net. So we don't know if we transfer a customer to Vodafone, for example, on the DSL, but they are changing to DSL in that case.
So effectively, they are going back to an inferior product.
Yeah.
Okay. Thank you.
Next question comes from Vivek from Deutsche Bank. Vivek, your line is open. Please go ahead.
Hi. Good morning, everyone. Can you hear me okay?
Yes. Yeah.
Okay. A couple of questions, if I may. I guess the first one is, you talked in the last call about potentially raising additional financing. I was wondering what your thoughts are. And obviously, I've just heard your comment on liquidity and how you expect that to develop over the course of the year due to changes in working capital. But I was just wondering, are there any other thoughts to draw on some of the carve-outs within the documentation? And if so, when? A second question I have is on CapEx. I mean, clearly, you see it coming down, but could you give us a sort of range as to where you expect full year CapEx for 2025? And then obviously in this quarter, we're still having the impact of the bulk migration. Margins are now at around 37%. Should we assume this as a run rate going forward? Thank you very much.
Thank you, Vivek. Nico speaking. Let me take the question. On the additional financing, there is nothing new that we can add to what we've mentioned in the last call 4 weeks ago. So still exploring options, what is available opportunistically, looking at possibilities that may or may not arise, but there is nothing clearly showing up on the horizon that we can communicate to the market. So there's nothing to add as of today. On CapEx, I mean, as we suspended guidance, this is basically more on the top line and EBITDA on CapEx. We will look at what it is, but we've given an outlook in the last call and in the annual report going for the current fiscal year. As we are now putting back all measures on basically looking at them and seeing if they're necessary, how we can shift them, we would probably try to lower investments where not needed to offset any potential pressures that may arise from the market that we've previously discussed. The last question, I wasn't 100% sure what you referred to. You said 37%. I think you probably mentioned the 47% on the bulk retained customers. Can you please specify, Vivek?
So I'm just talking about what do you think, post the bulk migration, what do you think your sort of profitability levels, margins should be going forward? Not the retention, but just talking about the group level.
You're talking profitability margins, EBITDA margins, or what?
Correct. Yes, sir.
Yeah, and also no true guidance here today. I mean, if we look at the current levels and bulk is basically more or less washed out, this is what we currently see in terms of profitability. And now what we do is we tackle the cost side. And we mentioned it, if we do take out quite an aggressive approach here and increase and accelerate these measures, this will hopefully then have a long-term improvement going forward. If we scale back the structure and the operational costs in relation to the top line, this should substantially improve where we need to go.
As a reminder, that's star followed by 1 on your telephone keypad to ask a question today. We have a question from Jean-Yves Guibert from BlueBay. Your line is now open. Please go ahead.
Hi, good morning. Just as a follow-up, reformulating your comment about the profitability and also the fact that Q1 25, the revenue were up sequentially. The fact that the TV access bulk revenue were flat sequentially at representing only now 10% of the TV revenue. Just trying to understand the dynamics behind the drop in profitability in Q1 25 versus Q4 2024, given the bulk migration impact was already the same in Q4 versus Q1? If you can work out the reason why the profitability is down 7 percentage points, while actually your normalized margin, whatever gross margin or contribution margin, is actually stable at 70% plus. So that's something into the OpEx. If you can work out, please. Thank you.
What we did see in Q1 compared to Q1 last year is that on the other direct costs.
No, so I'm afraid I want to compare Q on Q. So Q1 25 versus Q4 24, i.e., on the same TV access bulk revenue basis.
Yeah. Okay. I'll need to take that question. I don't have the answer out of my head here. Sorry.
Okay.
Nothing further in the queue at this time, so as a final reminder, that's star followed by 1 on your telephone keypad to ask a question today. If you joined us online, please use the dial-in details to the left of your slides. We have a follow-up from James at New Street Research. James, please go ahead.
Yes, hi. Yes, I'm going to ask a follow-up question. Thank you. So one thing you kind of highlight in the kind of XLS pack is that you have changed your ARPU definition, and it looks like, you know, one of the main drivers actually of the ARPU growth is coming from the increased fees you're getting on hardware, whereas the kind of ARPU on the old basis was reasonably flat. And looking at the hardware side, I mean, it looks like that has, you know, you made a major increase on that in Q2 last year. So, you know, are we going to be getting to a position where we're going to kind of lap some of the price increases on hardware, and that could potentially put some of the ARPU growth rates you're seeing slightly at risk? And then if I could just follow up from one of the earlier questions, Nikolay, could you confirm that, like, over the whole year, you're expecting the working capital number to be broadly zero for 2025? So in other words, you can claw back the 26 million Q1 outflow by the time we end the year. Thank you.
Sure. James, on the ARPU and the additional information we gave in the toolkit, basically, I inherited a ARPU calculation which was very long ago defined, almost 10 years ago, and some of it always was difficult to reconcile these ARPU numbers if you took P times Q to come up to the product segment revenue numbers. And what I asked the team is to basically come up that it would be easier for the market to understand P times Q subscriber numbers on average times the ARPU would get you much closer to the revenues we show. Why do we include hardware into ARPUs? It's part of the product, and it's a recurring revenue because people rent this and they pay 3, 5, 6 euros depending on whatever hardware they choose, and it's a continuous part of ARPU. And therefore, it is part of the whole package. So if you say headline price is 30 euros, but you always have 3 euros, 5 euros on top for hardware, then the customer is paying 35 euros. And that is what is a recurring revenue from the customer. And therefore, it's legit to really put it in and like-for-like comparison. That's why we started to do the backwards calculation to give you a comparison also to 24 to see what is happening if you had these hardware revenues already included in ARPU. So you have a trajectory coming from 2024 and then going onward. I think if you adjust your models basically now with this information, this is much closer and gives you a better information on our performance. And that was the reasoning behind the ARPUs. I hope that explains like the impact. And if you said, let's say the hardware impact on growth is, or the hardware share is roughly 9-10% of total ARPU. And that is what this hardware really makes part of it. So if you go to the 2027 blended internet and phone ARPU that we show, round about 25 is the underlying true, let's say, service, and the remainder is related to the hardware rental that comes on a month-by-month basis.
So that all makes complete sense to me, but I suppose I was really asking about the kind of phasing. So if I look, you did disclose the hardware revenue in the past, and that through 2023 was only about 2 million or 1.5 million euros a quarter, and then it suddenly stepped up during 2024. It was running at 5 million a quarter. So a lot of your ARPU growth seems to have come from higher hardware revenues. I suppose my real question is, can you put through a further increase on hardware, or is the 5 million you were exiting 2024 at now a more stable quarterly run rate for that?
Yeah, sorry, I forgot the second part of the question. Exactly. First of all, we introduced it into all the products, so that was one decision last year. And secondly, the prices were increased for the hardware. So there were two effects in 24 when this was introduced. I think it was one of the first things Jochen basically decided to do when he joined in the summer, and then going forward, he prepared to introduce it on all the products and also to increase levels by, I don't know, 1 or 2 euros in relation to the hardware being used. So that is the reason why there was this jump last year, and now I think it's just part of the normal portfolio, and we would see hopefully the steady growth because it's simply one part of the service product to the end customer. And then on your working capital, on the working capital question, is it going to fully net out to zero? Probably not. I would probably, the latest what I have seen is that we might take out around 80% of the impact from Q1, but in the end there might be some remaining negative impact that we cannot fully offset the Q1.
That's clear. Thank you very much.
You're welcome.
The next question comes from Giacomo Beretta from Gryan Capital Management. Your line is now open. Please go ahead.
Hey, hi guys. Thanks for the call. I just have one question on the homes upgrade. Morton to build have somehow stalled, and also
Giacomo, sorry, we lost you for a second. Can you please repeat the question? We lost you.
Yeah, can you hear me now?
Yes.
Okay, perfect. If you can give us an update and an overview on the full year 25 for contracts won and open to build, because it seems to have stalled over the last quarters, and also an update on the expected network upgrade, particularly on the FTTH side. It seems that you are at 199,000. Just where do you expect to be at the end of the year? Thank you.
Yeah, sure. I mean, in terms of what has happened in the waterfall, if you go to the toolkit, we did see some changes on the numbers that we are currently in negotiation and processing and internal in the internal, let's say, approval process. So we had seen a big jump. I think that came from around 70 to 170. So 100,000 more homes connected for fiberization are in the pipeline being worked on, while, let's say, one and open to build and the waiting for customer approval is more or less the same, but it's moving upwards in the food chain. So we've basically filled the sales funnel again at the bottom, and now we are processing it through. So building was, I think, 11K in terms of internet fiber to the homes connected, and that is normally Q1 is normally always again lower than Q4. We had a stronger quarter in Q4, which is what I explained previously to seasonality. We're still expecting to to build up what we've mentioned previously. Again, we're looking at these measures at the moment, what is needed in terms of demand from the housing association, but the pipeline is filled up, and it's on us and in the discussion with the housing association to decide when it's the right moment in terms of execution of these fiberization projects, basically.
So the 11,000 additional FTTH customers, is it expected to be at the run rate, or do you expect the end of the year to be 11,000 times 4?
I would expect it to be slightly higher than the 11 times 4. So we always guided in the range of, I think, 60 to 70K by the end of this year. But this might be looked at, and we'll see how the market develops and where we have to or where we may have opportunity to decide on the timing.
Okay, got it. Thank you very much.
The next question comes from Antonio Barranco from BlackRock. Antonio, your line is open. Please go ahead.
Hi, thank you very much for taking my two questions. So the first question is in relation with the operational excellence, the first phase that was agreed. I want to understand if any impact of that first phase is in the employee cost in Q1 or not, or whether should we expect in Q2, and whether you can help us to understand the impact. That's the first question. And the second question, I have not seen any reference to the NetCo separation, neither in the slides nor in the call. Can you please give us an update on whether this, I guess, deterioration in the market environment has any impacts on your plans in that front? Thank you.
So on the first question, Antonio, there is a smaller impact in Q1 on the cost side on our FTE program, and this will be now accelerated month by month and quarter by quarter. This is what we all actually see already, and will increase through additional measures I mentioned before.
Then maybe if I add, part of the non-recs that you see is also related to the restructuring on the personnel side and on the transformation side. So those two topics are basically the non-recs for the current year, and the execution of the first program that has been agreed and signed, and where we took the provision in December, that is now being executed over the next. That was a program over the 2 years agreed with the Works Council. We're obviously pulling this forward and accelerating it. And the next steps are to be discussed and announced shortly internally, and then we will execute and see impacts coming over the next couple of quarters. In terms of reference to the NetCo-ServCo situation, to be honest, in the last 4 weeks, not much had changed, so therefore I simply took it out. Obviously, we are doing the stuff that we mentioned 4 weeks ago. I can give you one example. This Sunday, we have an integration of the so-called Cottbus entities. It's 4 legal entities that we finally migrate into our own systems. We connect them to our network. We bring the customers into our billing system. So there is projects being executed. This is all being done and continued as we basically proclaimed 4 weeks ago. So everything is on track, that we continue to do the bits and pieces, the finalization of these outstanding topics. But besides that, there is nothing really new to say compared to 4 weeks ago.
Okay, thank you.
You're welcome.
As a reminder, that's star followed by 1. We have a follow-up from Martino at Tiki. Martino, your line is open. Please go ahead.
Thank you. Just a follow-up from Antonio's question. I was wondering if you could guide to a quantum of the efficiency program. I understand the timing. I was just wondering if you had already a total quantum in mind for fiscal year 25 and then a run rate for fiscal year 26.
What we've done is that I think we mentioned that based on last year, the program that we announced, the social plan, I think that number we already announced was around 150 FTEs. What we decide now to do is not yet fully visible. So I would probably relate to the next quarter when we have decided and started execution. But it will be a program of a substantial program, probably at least of the same size. But let's wait and see, please.
Thank you. And then I had a question on the agreement you signed with Eurofiber Nets very recently. I was wondering whether that is going to have any impact on revenues and EBITDA in the short term, or whether you could share something about this ServCo agreement.
Yeah, happy to do so. Martino, sorry. A huge impact. No, because we are in the implementation phase, both sides. So on the Eurofiber as well on the Tele Columbus side. So there will be no bigger impacts in 25. But at the end for us, it is together with Eurofiber to find out what from a ServCo side these whole buy relationships are capable for. And for that, optionalities for others to follow is the biggest point for us in that decision signing that contract.
Thank you.
We have a follow-up from Yves at Blue Bay. Your line is now open. Please go ahead.
Yeah, thank you very much. Housekeeping question. In Q1, you reported a cash interest payment of 6 million, which seems to be very high in the context of your reinstated debt. My understanding is that you are paying only a 50 basis point cash component on the TLB, while the fixed notes were fully PIKing, which would have implied around 3 million of cash interest on an annual basis. So if you can help us reconcile the 6 million of cash interest expense in Q1, please. Thank you.
Jean-Yves, normally the interest also includes the interest that is paid on the leasing liabilities. That's my understanding. So we had a interest payment, I think it's biannual, twice a year, and one is March, one is September, and that's what you refer to, the term loan 0.5% cash interest. That's one portion. And then the rest, to my understanding, is that the part that we show on lease payments is twofold. It's shown in one line and then in another line, which is the interest. That is my understanding.
Okay, makes sense. Thank you very much.
You're welcome.
Nothing further in the queue, so the final call, star one. We have no further questions, so I'll hand the call back to Markus for some closing comments.
Okay, thank you for attending our Q1 results. Thank you for your questions. Might be follow-ups, and thank you for the interest in our company. I would say we hear us in maybe in some one-on-one discussions, and end of August, I think, or August is the next for the Q2 results. Thank you very much for attending, and have a good day. Bye.
Thank you. Bye.
This concludes today's call. Thank you very much for your attendance. You may now disconnect your lines.